We are constantly bombarded with these terrifying headlines about the everything bubble bursting or the impending absolute collapse of the US dollar. So in today's explainer, we're diving straight into these looming 2026 market crash warnings, but we're going to focus on how to actually protect your wealth using hard data. Look, if you're on the path to financial independence and early retirement, the whole FIRE movement, this kind of noise can be incredibly stressful. So today, we aren't just going to stare at the alarmist headlines. Let's actually stress test these extreme predictions against market reality, break down the mechanics of wealth preservation, and give you some actionable steps to fortify your portfolio.
Let's kick things off with a pretty wild, highly provocative warning from the famous Rich Dad, Poor Dad author, Robert Kiyosaki. He recently jumped on social media to claim that a historic economic collapse, like possibly a full-blown Great Depression, is imminent right around 2026. And he bluntly asks his followers this question: will you be, quote, messed up or lucked up? I mean, it's a super aggressive framing, but it's totally designed to grab your attention. Kiyosaki has basically built an entire empire on challenging conventional financial wisdom. He argues that the traditional advice, getting a good job, saving cash in the bank, investing in a diversified mutual fund, is just totally obsolete. But to really understand his warning, we kind of have to look at the man behind the message.
Because what is truly staggering here is that the very guy warning us all of global financial ruin admits to being over $1 billion in debt himself. Just let that sink in for a second. $1 billion. But here's the catch. He is using it as a deliberate strategy. Kiyosaki famously said, "If I go bust, the bank goes bust. Not my problem." He actively advocates for using massive amounts of debt to acquire hard assets, like real estate and precious metals. It's a strategy that relies heavily on leverage. Now, while this might work out for a highly sophisticated, ultra-wealthy investor who understands complex corporate shielding, applying this level of extreme leverage is literally playing with fire for the average FIRE investor who's just trying to build sustainable, long-term wealth.
So before we all give in to the doom-scrolling panic that these headlines are specifically designed to generate, we really need to objectively fact-check these claims against actual market reality. While Kiyosaki is undoubtedly a brilliant storyteller and an amazing motivator, his track record definitely has some serious asterisks. For instance, back in 2012, one of his companies, Rich Global LLC, actually filed for bankruptcy after a massive royalty dispute. On top of that, financial investigative journalists have pointed out for years that his wealth-building seminars often face complaints for providing, questionable value at exorbitant prices. The point here isn't to just completely dismiss the guy, but we have to recognize that extreme predictions often drive seminar and book sales just as much as they drive genuine financial strategy.
Actually, his Bitcoin predictions are the perfect illustration of why blind faith is so dangerous. Kiyosaki boldly predicted that Bitcoin would reach $350,000 by 2025 as sort of an insurance policy against the crash of fiat currency. Yet, when we look at the hard data, it shows a very different reality. Bitcoin has been trading much lower, hovering right around the $86,000 mark. And you know what happened? When his initial projection failed to materialize, he just quietly revised it downward. This massive gap between his prediction and reality shows exactly why betting your entire FIRE portfolio on speculative timing is incredibly risky. We absolutely need a strategy grounded in data, not just dramatic forecasts.
Now, despite some of those missed predictions, Kiyosaki points back to past crashes like 1987, the 2000 dot-com bubble, the 2008 financial crisis as proof that severe volatility is actually a massive wealth-building opportunity, if you're prepared for it. He argues that he got richer, not poorer, during those specific downturns. And honestly, there is a fundamental truth there that pretty much all successful investors agree on. Market cycles are completely inevitable, and market crashes effectively put high-quality assets on sale. A crash is, at its core, simply a transfer of wealth from the fearful and unprepared over to the educated and patient.
To actually capitalize on these crashes, we really have to grasp his core philosophy. He argues that ever since the U.S. left the gold standard back in 1971, fiat money, the actual paper dollars sitting in your wallet right now, is merely an illusion propped up entirely by confidence. Because the government can just print money endlessly, he firmly believes that cash is trash, simply because inflation will inevitably eat away its purchasing power. And this is exactly why he pushes so aggressively for hard assets. We're talking physical gold, silver, real estate, and more recently, Bitcoin. He views all of these as tangible stores of value that just cannot be inflated away by a central bank.
And that leads us to perhaps the greatest financial lesson he ever popularized. It's this foundational rule right here. To survive a crash, you must relentlessly acquire cash-flowing assets instead of vanity liabilities. I know, it sounds incredibly simple, right? But most people get it completely wrong. A true asset puts money into your pocket every single month. Think rental income or stock dividends. A liability? Well, that takes money out of your pocket, like a massive mortgage on an oversized personal home, a luxury car payment, or high-interest credit card debt. If you want to truly fireproof your life, your number one job is to constantly expand that asset column.
But hold on, we really need to balance Kiyosaki's alarmist push for hard assets with the elegantly simple, completely data-driven Boglehead philosophy of passive index investing. Think of it this way. If Kiyosaki represents the entrepreneurial, highly leveraged, somewhat risky approach, the Bogleheads represent the steady, strictly mathematical approach. Founded on the principles of Vanguard's legendary John Bogle, this strategy says you absolutely should not try to time the market or pick individual winning assets. Instead, you should just passionately buy the whole haystack. It's an approach built entirely on holding low-cost, broadly diversified index funds like the S&P 500 and simply letting the undeniable magic of compound interest do all the heavy lifting for you over decades.
Because trying to time a 2026 market crash with expensive, actively managed funds or speculative stock picking, statistically, it is a massive losing game. Just look at the hard data. Over a 20-year period, a staggering 85 to 98% of actively managed funds actually underperform the benchmark index. This even includes the advisors that personalities like Dave Ramsey sometimes recommend, who charge a 1% fee just to try and beat the market. And guess what? That little 1% fee can eat up a massive 25% of your total portfolio returns over 30 years. Holding a low-cost index fund consistently beats the active managers because it totally removes the emotional errors of panic selling and the exorbitant fees of active trading.
Plus, when we zoom out and look at the broader economic data, this whole end-of-the-world narrative really starts to crack. For example, contrary to the hyperinflationary panic you hear online, the USDA actually forecasts that grocery inflation will stabilize at a remarkably low 1.7% in 2026. That is well below the 20-year average. So the real defense mechanism here isn't trying to find a magic asset class. It's behavioral discipline. Boglehead indexing requires massive emotional restraint to stay the course during a dip, while figures like Dave Ramsey or Robert Kiyosaki offer strict behavioral guardrails, whether that's Ramsey's extreme debt-free living or Kiyosaki's strict rule to only buy things that pay you.
Okay, so let's extract the absolute best from both of these worlds, the hard asset entrepreneurial side and the passive indexing mathematical side, to build a genuinely recession-proof portfolio for the FIRE community. Because you don't actually have to choose between being a cash flow real estate mogul or a pure indexer. The ultra-wealthy often use what's called a barbell approach. They balance absolute safety with selective, high-conviction risk. If we know a crash is mathematically possible, but timing it perfectly is totally impossible, how do we adjust our machinery today?
Well, by following a few specific steps, you can filter out the panic entirely and protect your wealth. First up, radically audit your life right now. Focus on buying real assets, not consumer liabilities that are just disguised as investments. Second, manage your risk by ensuring your assets generate actual, reliable cash flow and rigorously eliminate bad consumer debt so you aren't financially squeezed if lending suddenly freezes up. And finally, do not abandon your core index funds. Maintain a strong, low-cost, Boglehead index core. That practically guarantees you'll capture the long-term upward trajectory of the broader market, even if we do see a temporary dip in 2026.
Because as Kiyosaki beautifully notes, great opportunities are not seen with your eyes, they're seen with your mind. A market downturn is simply a wealth transfer event for the people who view the economy with an educated mind rather than fearful eyes. Think about it. If you have solid cash flow, zero toxic debt, and a highly disciplined indexing strategy, a crash isn't a crisis at all. It's literally just a massive discount sale on the world's best assets.
So when the next market correction hits, whether it happens in 2026 or 2036, will you let fear and those alarmist headlines dictate your financial future? Are you going to just doom scroll through the panic, or are you ready to take data-driven action today to build an absolute fortress around your wealth? That choice, and the financial independence that comes with it, is entirely up to you. Keep learning, keep building, and we'll see you in the next explainer.